What factors affect long-term car insurance rates? Imagine trying to plan your budget for the next few years without knowing what your car insurance might cost. It can be tricky, right? Well, understanding what influences long-term car insurance rates can help you make smarter choices when shopping for auto insurance and comparing auto insurance quotes. First, your age and driving experience play a big role. Drivers between 25 and 65 usually pay less because they are seen as safer drivers. Younger drivers under 25 or older drivers over 65 tend to have higher rates because they are statistically more likely to be involved in accidents. The more years you have driven without incidents, the lower your rates often are. Your driving record is another key factor. If you have a clean record with no accidents, tickets, or claims, insurers see you as less risky. But if you have a history of traffic violations or frequent claims, expect your premiums to go up. Even small infractions can add to your costs over time. Where you live also impacts your rates. Urban areas with heavy traffic, higher theft rates, or more accidents tend to have higher premiums. If you move to a different zip code, your rates might change because local risks vary. For example, living in a city with a high crime rate can increase your insurance costs compared to a rural area. The type of vehicle you drive makes a difference too. Luxury cars, sports cars, or vehicles with large engines often cost more to insure because they are more expensive to repair or are involved in more risky driving. On the other hand, older cars with fewer safety features might have higher rates if they lack modern safety technology. New cars with advanced safety features can sometimes lower premiums because they reduce the chance of injury or damage. How much you drive each year also matters. If you use your car for long daily commutes or have a high annual mileage, your risk of accidents increases, which can raise your rates. Conversely, driving less than 5,000 miles a year might qualify you for lower premiums. Your credit history is used by many insurers to help determine your rates. A good credit score suggests you are financially responsible, which can lead to lower premiums. Poor credit, however, can increase your costs because it is linked to a higher chance of filing claims. The coverage options you choose also influence your rates. Higher liability limits, comprehensive coverage, or lower deductibles will cost more. But taking advantage of discounts can help reduce your long-term costs. For example, safe driving discounts, bundling policies, or installing safety devices like alarms or anti-theft systems can all lower your premiums. External factors beyond your control can also affect your rates. If local accident or theft rates increase, insurance companies might raise premiums across the board, even if your personal record stays clean. Rising repair costs or changes in the insurance market can also cause rates to fluctuate over time. When comparing long-term auto insurance quotes, think about how these factors relate to your situation. Keeping a clean driving record, choosing a safe and reliable vehicle, and being mindful of your annual mileage can help you manage costs. Also, staying aware of local risk conditions can prevent surprises in your premiums. In the end, long-term car insurance rates are based on a mix of personal driving habits, vehicle details, location, and broader market trends. Knowing what influences these rates helps you make better decisions when selecting and maintaining your auto insurance policy.